If you've been following the news, you're probably wondering what's ahead for our property markets and the economy because there have been clickbait headlines like the peak of the property market is upon us and there's too much investor lending. Well, in today's Property Insider video, Dr. Andrew Wilson and I go through some of the latest data to debunk some of the myths that are out there to give you some more clarity and certainty about what's ahead in our property markets in 2022. If you want to keep up to date with what's happening in the housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated every time a new show comes out. Boy, have there been some, let's call them interesting headlines in the mainstream media lately. Click-bate headlines like suddenly there's the peak in sight for our residential property prices, or investors are coming too late to the party, or there's too many investors, or lockdowns are going to cause a double-dip recession. Well, over the last week, there's been quite a lot of new data released, so today I'd like to get the thoughts of Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, and I want to ask him what this means for our economy and our property markets moving forward in this week's Property Insider video. Hi, Andrew.
Yes, good morning, Michael, and it has been a busy week in property, hasn't it? We've got plenty to discuss, and I guess it's the old story that it doesn't rain and it pours when we get to the end of the year. And we certainly have the end of the year in sight now.
Boy, don't we? Well, one of the topics that came up last week was how new home lending has changed. Lending to investors is red hot, but in fact, lending to home owners and first homeowners has dropped. And that's making various people speculate what's ahead.
Yes, look, we had the fifth consecutive month of falls in approvals for home lending, Michael. We've certainly seen consistent falls over that period. From both owner-occupiers and first-home buyers. And it's all about affordability. Prices have risen. It's starting to push buyers out of the market. You just can't keep borrowing more to keep up with red-hot prices growth. And of course, we're also seeing what's been a remarkable year, 18 months of demand now being satisfied. So a lot of that pent-up demand that was held back through various factors, particularly lockdown, has now been satisfied. So we're seeing less action. But when we look at the underlying nature of home lending, even though investor activity has bucked the trend and continued to grow, we shouldn't be surprised at that. When we look at market share for owner-occupiers and first-home buyers, although it has been falling, is still above average long-term levels, Michael. And conversely, investor lending, the market share for investor lending is still below its long-term levels. It's below 30% still investor lending as a proportion of total residential lending, and that's below the 33% long-term average. So we did see some speculation that when looking at the value of investor lending, which is the second highest on record, of course, we have to go way back to 2015 to see the previous record for the value of investor lending. But of course, prices have risen since 2015, Michael. So it's a very poor comparison to be saying we're near record levels of investors. In reality, we've seen the value of owner-occupier lending increase by 60% since 2015, and first home buyer, the value of lending is up on a monthly basis by 109%. So when we account for house price inflation, it does equate to what we see in terms of market share for investor activity. And that's why it's continuing to rise, because actually it's coming from quite a low base. But certainly the home lending cycle has peaked and is now easing. But that's just part of that natural stabilizer of higher prices starting to impinge on affordability and ease buyer activity.
Interestingly, when you aggregate it all, Andrew, there was about $30 billion worth of loans approved. So that means $1 billion worth of property transacted a day is going to happen over the next couple of months for these people who have actually got finance approved. So I like looking at finance approvals as a leading indicator of what's ahead. The other sort of thing we like looking at is what's happening to the economy, what's happening to inflation, what's happening to unemployment. And recently, the latest economic figures came in, and they weren't as bad as many economists had estimated.
Becoming a cliche, isn't it, Michael, with the financial commentary and various economists who've been doom and glooming our last couple of months, or maybe last couple of years, even further back, and they're getting it wrong consistently. And of course, they've got it wrong again on the economy. The latest GDP numbers came out for the September quarter. It showed a predictable decline of 1.9% in GDP over the quarter. And of course, that was a lot better than many had predicted. And it really does set us up for quite a solid rebound over the December quarter. So that highly fatuous speculation regarding another recession has certainly disappeared quite quickly. And when we look at the breakdown of gross state product to see how the states went, the decline in GDP was clearly a result of sharp decline in New South Wales, declines in Victoria, and a decline in ACT. And of course, we all know the reason why, and that was because of lockdowns during the September quarter. But when we look at the other states, they all performed quite well, Michael. So sadly for those that have been predicting a double dip recession, not going to happen. In fact, it was quite a reasonable result given the constraints of lockdown. It was quite a reasonable result, declining by just 1.9%. So the Australian economy keeps on keeping on, robust and resilient. And of course, we learned the lessons from the previous lockdown in terms of businesses adapting and consumers adapting.
Well, the lockdowns have ended in October, so there's the prospect of a sharp rebound in the next quarter, the December quarter that we're in at the moment.
Absolutely. And of course, that means that we won't have those consecutive quarters of negative GDP as we had last year. And really, last year's recession was a bit of a Clayton's recession. That wasn't really a recession because it was down just 0.3% over the March quarter last year. And of course, it dipped by a record over 7% in the June quarter. But it really was only that one June quarter that was reflective of poor economic performance. So even though it was a technical recession, it was just a technical recession by the skin of its teeth, Michael, and we're not going to get another one, that's for sure.
Well, if we look at the property markets, we like seeing what's happened in the auction markets because it's a better real-time indicator of the depth of the market, of the mood of the market, rather than the results which show what happened last month. And December commenced with a wave of auction listings, didn't it?
Well, we've seen that really over the last month, Michael. It's not unusual at this time of the year to see a surge in auction listings. It's a seasonal effect, of course. Vendors wanting to sell their properties before the end of the year. We always see listings rise through November and into December, and then, of course, fall away ahead of the holiday break. But we've had it added to this year, of course, because there's been some disturbed patterns of vendor activity because of lockdown. So we've seen those vendors who have had their plans interrupted because of lockdown have added to the usual end of year seasonal effect. And of course, what we also see with higher numbers of listings at the end of the year, Michael, are lower clearance rates. So that's all part of that seasonal impact. Of course, the old law of supply and demand, and buyers tend to start giving up because Christmas is approaching and they get distracted. So we do see lower clearance rates, and we've seen that over recent weekends, particularly in the big markets of Sydney and Melbourne. Well, most markets have eased in terms of clearance rate outcomes. But I thought what was interesting, we had another very big weekend of auctions to start December this weekend. That was a record December day for the Sydney auction market, highest number of auctions ever conducted on a December Saturday, and another very big number in Melbourne as well, just below previous weekend's total. But I thought what was very instructive, Michael, was that really auction clearance rates held their own despite another big weekend of listings. And I think that shows that the market's still got plenty of force in it, that there's still plenty of buyer depth out there. Sydney's still well above 75% in terms of clearance rates, which is a good seller's market. And Melbourne's hovering just a little bit under 70%, again, indicating a seller's market and higher prices. But I do think that would be very positive results, despite that wave of auction numbers. Auction clearance rates held up in Melbourne and Sydney, held up in Adelaide and Canberra as well, still above 80%, a little lower in Brisbane. But Brisbane's been a superstar, Michael, this year. That Brisbane market, as we saw from the recent house price data that was released, and what we've been discussing for some time now, is that we've seen easing of those supercharged Melbourne and Sydney markets, but the Brisbane market has continued to rise. Again, the Brisbane market a little lower on the weekend in terms of clearance rates, but I think buyers are getting pretty distracted in the Brisbane market from what's been a real boom year for them.
I think one of the things looking forward for 2022 is that we've got to remember that sellers are buyers. A lot of people selling their properties now at auction are going to be in the market to look to upgrade, downgrade, move. So there's lots of good signs for the markets in 2022, Andrew.
Absolutely, Michael. And this is the point, that when we're seeing consolidation of clearance rates, despite a wave of stock coming into the market, I think it shows that there's still that buyer depth available. There's still upside to prices growth, and we've discussed that. I think prices will continue to rise next year, certainly not at the rate that we have had this year, because a lot of that pent-up demand has been satisfied. But it's still a very positive market. And as I said, I think that the weekend results are confirming that. Some very good results there despite high listing numbers.
So in summary, the economy is doing better than many expected, and sure, finance approvals are down. But if you look compared to a year or two ago, they're still pretty strong. So lots of green shoots, a couple of weeks left in our market. So look forward to catching up with you again next week, Andrew.
Thank you, Michael. Yes, plenty of legs left in our housing markets yet.